Welcome to our channel. My name is O'Brien and I would like to thank you for watching this video. If you find value in it, please like and subscribe. And if you have any questions, please put it in the comment area below. Thanks again for watching.
I jump in and talk about the VIX for a second, everyone. And what I'm going to point out is this VIX that is right here. Okay, this is the VIX. I'm gonna try to get some white space for us here. Let me clear this up here. All right, so the VIX, the VIX is the volatility index for the S&P 500. Okay, the S&P 500 could be the SPY. This is the ETF for the S&P 500. It could be the SPX, which is the cash settled index for the S&P 500, and then it's obviously the ES, the futures index for the S&P 500. This VIX represents all three of these. Okay, they also have a VIX that is the /VX. This is the futures volatility index. Okay, it's not the cash settled one, but we're going to be focusing primarily on this cash settled one. It's the most popular one, is VIX, and it is a index that is the inverse of the S&P 500. So when the S&P 500 is going up, almost 100% of the time, this VIX here is going down. And then it is the inverse of that. When the VIX is, or when the S&P 500 is going down, then usually 100% of the time, the VIX is going up. As you can see this morning, this VIX, this cash settled VIX, is going up. Not a lot right now, right? Because some of the pressure, some of the, the fear is coming out of the market, but it's still up this morning, right? And it's still close to what we consider a high level, and that's the 21. It just came below 21. Okay, that's what we jump into risk mode, and we try to be a lot more vigilant when the VIX is over 21, and we try to be a lot more vigilant when the VIX is 13 or below, or getting near that 13, because that's when we think the market is being too complacent. And when it's over 21, we believe the market is being too fearful. So we want to be more careful. Historically, this VIX is between the 15 and 17 level. That's the price right now. It's 2081. And when you are looking at the VIX, you can use the VIX to hedge. You can use the VIX to play against volatility, to bet against volatility. Okay, so when you are trading the VIX, let me just break this down. If you're going to bet against volatility, then you have to do something that's a little different than what we normally do. So for example, if we normally sell let's say a call spread, just for example purposes, if we normally sell a call spread, that is normally for us in almost, if any normal type of position, that is bearish. Okay, that is a bearish position. But when you're doing it in the VIX, because it's the inverse, this actually becomes a bullish position when you are the seller of a call or a call spread. It becomes a bullish, overall market bullish position. Okay, you're betting against volatility. You're betting that volatility is going to go down. And if volatility goes down, that means, like I said a few minutes ago, that means that almost 100% of the time the market is going up when volatility is going down. Okay, almost nothing is 100% in the world, or well, maybe some things are 100%, gravity or whatever, right? At least here on Earth, 100% of the time, you're gonna have gravity, and we hope that to be the case, right? But in the markets, nothing is 100% of the time. but some stuff is, some things are very close to that. Okay. And so when you're dealing with the VIX, you can literally trade the VIX in a way, trade against volatility. And this is a very, very powerful type of trade. In my personal account, for years, way over a decade, my number one trade was trading against volatility, literally using this VIX to fade volatility, especially when volatility was going up and so forth. Okay, so this can be a very, very powerful trade, especially on indexes or platforms like Thinkorswim, because before March of 2020, before the COVID era started, they would really give you an amazing margining benefit for trading this VIX. Okay, they still they still provide you a better margining than TastyWorks, because you can see TastyWorks gives you your full loss on this trade 32 days from now. We're selling the 29 and we're buying the 35. Okay, but it's giving you full loss here. If we go to Thinkorswim here and we bring this up, let me just show you here, and we're going to do the same thing. If I can get my fingers to work here. That's a little delay going on. All right, so there we go. So I hit this here, bring up the VIX, I'm going to hit clear down here, and I'm going to go to this 32 days, and I'm going to sell the same thing. Okay, I'm going to do the same type of spread. So we're going to sell the 29, I believe it was, and we're going to buy the 35 here. Okay, so this is going to be the same trade. And then if we hit review here to see how this looks, you can see that actually this is given the same type of trade scenario this morning. All right, so $57, 541 is the max. The buying power that they're requiring on the TastyWorks platform is pretty much the same. Sometime you'll get a different type of scenario. So let's see if we went and did something like this, made it a little wider. So you can see that this is the buying power here, 1480. Let's see if Thinkorswim changes that for us a little bit. Let's see if I can give a better example. All right, so that was 45, and we're going to go over here. We're going to change this Thinkorswim to 45. We're going to hit review and see what they're requiring. So you can see this is showing you a small difference, right? Or not a small difference. This is 50% difference, right? So Thinkorswim is requiring 709 to do this, and TastyWorks is requiring 1480. So it's a whole that's 50% difference in margining, right? Same stock type of index, but Thinkorswim is doing a lot cheaper. In the past, Thinkorswim would probably require $300 to do this, right? So you can see 113 over $300 is really awesome. This is actually not bad, right? This is more than 12%. So this is something we would still do based on our requirements. But I'm just trying to point out in the past that Thinkorswim would margin this so in just an amazing way, like no more than probably $300 to do this. But now after COVID, things have changed margining wise. The brokerage firms are a lot more vigilant about things, right? And you guys have probably experienced that with them liquidating positions faster and things like that. But things will get back to maybe a year from now. I don't know. Things will potentially go back to normal. Markets always have these cyclical processes that they're really fearful, and then there are really unfearful and get really complacent. So we'll have that time again. With that said, that's the VIX when you are trying to fade volatility. Okay, but you can also use the VIX as a hedge, because when the market is going down, almost 100% of the time, as we mentioned, this VIX is going to go up, and volatility can spike in a significant way that being long the VIX, buying a call or a call spread, could help offset your overall portfolio risk. Okay, so if you bought something similar to here, at the money here, and you bought this, and let's say it was 370, this is going to cost you 370. But if the VIX jumps up, and I just say it jumps up over 30, well, this is going to be worth a significant amount more if that's the case. And we can go up to 30 pretty fast. As you guys know, we were probably over 30 for a little bit last week. So this is a way to kind of hedge yourself. If the market goes down and volatility spikes up, you can use the VIX to hedge yourself. You can do it this way by buying a call, right? You can buy a call at the money. You can buy a call a little in the money. You can, and once again, you're not buying a put in this case, because this is the inverse of the S&P 500. Buying a put would not work for you, right? If the market is going down, this VIX is not going to be going down. It's going to be going up. So you need to buy a call in this scenario. Okay. So you can buy something at the money, a little in the money, or you can buy something further out that's going to be a little cheaper. But if volatility spikes, this is going to help you regardless, right? It's going to help you regardless, because volatility is going to spike, and this option strike, it's going to be worth a lot more if you get the volatility spike that is significant. Some people use this VIX as a kind of a apocalypse type of hedge, where they'll go and they'll buy a bunch of calls, for real far out of the money, something like, this or whatever, right? And they'll buy a bunch of them. As you can see, I'm changing the thing here. And this is really black swan type of scenario, right? This stuff works maybe once every, 15, 20 years or something, right? This scenario would have worked in March of 2020. But it would have been, way over a decade before it worked before, right? Besides 2020, it would have worked maybe in 2008. So it doesn't work a lot of times, right? You can be throwing away your money for, a decade before this kind of hedge works for you. So you can do these. It's not really my thing. My thing is, if I'm using the VIX as a hedge, and we talk about this in lesson 8 of the Dorian Way School in course 1, is that I'm normally buying it at the money, a call, or I'm going to buy some type of call spread. Sometime I'll do something, sometime I'll do something like this, that I, even though it's only $30, this will hedge me 170. This can be a replacement of the type of normal hedges that we do when we're buying something like a put spread in the SPY or the IWM, that's the Russell, or the QQQ, that's the NASDAQ 100. All of those are ways you can hedge yourself, and but this is a way that you can hedge using instead of using those, but it's not going to be direct. Those are direct. This is somewhat indirect, right? Because the market could go down, but it doesn't necessarily mean the VIX is going to go up all the time, or it doesn't necessarily mean the VIX is going to go up in a way that helps you with the hedge that you have on, right? The VIX can go up a little bit, and this hedge can actually start losing money, because it's volatility. Okay, volatility is the only kind of mean reverting instrument or product out there. It's always going to go back to its historical average, but it doesn't necessarily mean that it's going to always spike up. Most of the time it does if the market's going down, but it doesn't always that's not always the case. So if you want to 100% of the time benefit from something going against you, you have to hedge something that's direct, okay, not indirect.